Of course, I always like to start off the week with a summary of what I saw happening with the stock market this week. And if you look at this chart here, we've got the year-to-date S&P 500. The little blue line there is the 200-day moving average, and that red line is kind of the trend line that's connecting the major points as far as that goes. If you look at what's happened most recently, just over Easan's head there, we've had quite a run-up here. And what happened was, for this week is very interesting because early in the week, Wednesday and what have you, we started to see the potential for something breaking. And we've been talking about something breaking for quite a while because of the fact that, you're tightening up money supply, you are raising interest rates, and something often breaks. And we saw, one of the exchanges within the cryptocurrency world basically faltered and has now been, seized for all intents and purposes by Bahamas authorities. And so the market had dropped a couple percent that day. The next day, on Thursday of this week, the CPI report came out. And here's what it showed. And you can see by that big green bar there, right over Eason's head, that it was a good report. We were up 5.5% yesterday on the S&P 500, which is a really big move. And then today we're following through. We're up a little over 1% already today also. So it's good to see follow through as far as that goes. So this is the CPI report for the last 12 months. And so you can see, we peaked out there in July and really kind of coming down. But this last piece is 7.75. The consensus, and this would have been for last month, for October, the consensus was that the inflation grew at 7.9 to 8.1%, depending on what you were looking at. And so coming at 7.75 was a big surprise. That's why the market moved up. Mostly you see these market moves that are really strong like that because there's so many people shorting the stock market, expecting things to continue to go down, and then there's a surprise to the upside, and they have to go back and buy those stocks back, to cover their shorts. And of course, when they do that, that raises prices even more. We saw a lot of companies that had high short interest do extremely well yesterday. But not to diminish the fact that the stock market did go up substantially for that one day, because sometimes a short covering, I'll put this out there, the next big rally that comes, if we go back to this chart here, the next big rally that comes and changes that 200-day moving average to up and breaks through that red line there, it will probably start with short covering. I mean, that's kind of how it all starts. Now, unfortunately, we've had so many examples where short covering has rapidly moved the markets up this year, and then it's fallen apart again. But that is a big deal. That's kind of how it works. And here's core inflation. So the chart for core inflation, now core just means they take out energy and food, all right? The chart for that, it doesn't look quite as good because it's actually been going up for a couple months in a row. It's now down to 6.3%, which isn't bad, but it's still kind of high. And core is more important to the Federal Reserve. It's more what they look at. And actually, the measure that the Federal Reserve looked at is called PCE, which is Personal Consumption Expenditure Index. Now, this isn't reported until the end of this month. So the chart here is actually showing for what happened in September. I would expect that October would come down. And the only reason I really show this is because a lot of people say, oh, inflation's at 7.75. The Fed has to go all the way down to 2%. There's a long ways to go. No, the 2% is core PCE, which was at 5.1%, probably drops down into the 4s once they report it for October here at the end of this month. And so still quite a ways to go, unfortunately, to get from 5, 4, high 4s, whatever it might be, down to 2%. But it's not as far as what a lot of people are thinking, having to come down from this, overall CPI inflation report. And so this is the measure that they look at as far as that goes. So I throw that out there because I think that's kind of interesting. So what does this mean for the stock market as far as we're concerned? Well, first of all, we reversed our inverse position yesterday with that strong move from a inverse S&P 500 position to buying long the Vanguard Total Stock Market Index. And we did that yesterday morning. And the reason we did that is because that move was so strong, and the fact that the possibility that inflation actually does slow down faster than expected. right? Because that's what people are looking for right now. Something to happen on the positive side. Is it enough to say, hey, it's all over and we're going, crazy to the upside now? I don't think so, but you never know. So we have about a third of our exposure that we normally would have to the stock market back in the stock market, but we don't have all of it back in the stock market. And so, there's some reasons for that. First of all, we're in a downtrend, right? I mean, so if you look at that, one of the things you look at for a downtrend is, are the highs lower? Yes. You look at those big peaks, they're all still going down. We haven't broken that yet. And that red line kind of shows that, that trend. Haven't broken through that trend. Is the price below the 200-day moving average? Yes. Is the 200-day moving average going down? Yes. So we've got to see something. Now, here's something interesting, though. Look at how close we are to the 200-day moving average now, and even to that trend. And so that's about 8% from where we are right now. So if we get another 8% in gains, we will get to the 200-day moving average. But it's important to remember that it actually has to break through with some power. It broke through in March back there and fell apart, touched it during the day in August. And so we'd like to see that happen. But there are some concerning pieces facing us that we have to kind of look at. And so, first of all, we've been looking at this 2-year Treasury yield. And so the green line there is the yield. And you can see, how much that's been coming up, over this period of time here, a little over a year. And I've drawn some red trend lines in there. And so you can see that most aggressive line, the most current one, actually broke through that yesterday, just a little bit. So that's a good sign, because we need to see that coming down for the stock market to go up. And the reason is, this is a projection, essentially, for what the Federal Reserve might be doing in the future with their rate increases. So not enough to say they're going to start pausing or lowering rates, but that's a good sign. But the other longer red line there is the longer trend line. It still hasn't gotten really close to breaking that. The 200-day moving average is that blue line. It certainly doesn't look like the stock market. It looks exactly the opposite stock market, which is exactly why we follow this, because it's an inverse related component. So still like to see some more deterioration there in terms of the yield on the 2-year. We have seen some, so that's good. Here is money supply. So this goes back to 1960. This is kind of a funny looking chart, but this is M2 money supply, which is one of the components of money supply. And the thing that's important to realize here is, first of all, if you look closely at that, it basically has never gone down since 1960. A couple periods of time where it kind of floated sideways and what have you. And I know it's hard to see here, but it's been going down all year, this year. So that's a really big deal. So what happens with money supply starts to shrink, it really tightens things up. And of course, that can create those types of problems where something breaks. Yeah. And so now I will say, although it is coming down, you can see how it went almost vertical there in 2020. So this was a tremendous amount of money supply pumped out. This is why we have inflation. Yeah. That came out, in that time period. So maybe the combination is okay. So that way too much money coming out in a short period of time might be all right to have some downturn here, and maybe this doesn't have a big impact, but it's definitely something we would watch for, because it is an important component. So I'd really like to see that 2-year Treasury coming down before we start jumping back in. Really like to see the stock market jumping back through the 200-day moving average. Love to see, money supply at least stabilize at some point in time. These are all things that would be positives for the stock market. The other thing is that we have these inverted yield curve components. So go back to July, the 2-year Treasury started paying more than the 10-year Treasury. So this is a precursor to a recession, and it's been under that for a long time, right? Then we go back to, just last month, and the 3-month, this is 25th of October, the 3-month has started to pay less than the 10-year. This is an even more accurate gauge of recession. And so recession would be 12 months on average. So next October, let's say, stock market would probably have some troubles with this as far as that goes. Then, just this week, this is what's called the near-term recession risk component. This is actually Chairman Powell's favorite measure of recession indicator. And what it is the expectation for what a 3-month T-bill will pay 18 months from now, a year and a half from now, versus what it's paying now. And so as of Thursday, that inverted. So in other words, they're paying more now than they will in 18 months on a projection basis. And you can see if you look back that this, went past zero, inverted, before the 2000, the big red column there, and before the 2008. But maybe more importantly here, this is the gauge that the Fed is watching the most. So here's the strange thing, though. This can go either way because the Fed looks at this and says, okay, maybe we should slow down, theoretically, our rate increases because now we have our preferred measure of recession coming, and we don't want to kill everything trying to bring this down, and so maybe we slow down the pace, or maybe we eventually pause, those types of things. So the market looks at this possibly as a positive. Mm-hmm. But then you've got the other side of this, which is that it is predicting a recession, which could affect earnings. And so how much is that recession? Is it a soft, shallow recession? Is it a hard recession? Does something break? So that's why, again, having a third of the stocks in the market still makes some sense to me, because the paths that are out there, there's some good paths that are happening here, but there's also some other ones that are not so good. So you got to be a little bit careful. This is not a clean runway to an upturn here with all the things that are happening. And so, but on a positive note, there's quite a bit of upward pressure on the market during this time of the year. Number one is we just had a midterm election. We talked about this on the last show, that the midterm election is a really big catalyst for the stock market to the upside. I believe the rate of return on the S&P 500 after the midterm election is roughly 10% between that and the end of the year. So that's really strong, right? And then we also have this situation with a lower CPI that just came out. And we don't have anything else for a while. The next time CPI comes out is the 13th of December. And then the Fed Reserve does their question and answer and announcement of what they're doing with rates on the 14th of December, the next day. So if you want to circle 2 days on your calendar that are coming up, those are good ones to look at. But what's happening here is that there's a good chance that this could run in between times, because there's really nothing else happening other than the cryptocurrency piece, which continues to kind of hang in there on a deterioration basis. So, again, if something breaks between now and December 13th, that could cause a downturn. But I think it's actually more likely without that we will see a continuation of this run up. And it's why we went ahead and moved our inverse to a long position as far as that goes. So that's what we see in the markets here so far for the week, and really look forward to being able to look at this again next week.